how clearing and settlement really work, and why delays still exist. Every day, trillions of dollars in financial transactions are executed across global markets. Stocks are bought and sold, bonds change hands, derivatives contracts are entered and exited, currencies are exchanged across borders. Trillions of dollars every single day, and almost none of it settles instantly. If you have ever bought a stock and noticed that the shares did not actually appear in your account until 2 days later, you have encountered the settlement system. If you have ever wired money internationally and watched it disappear for 24 or 48 hours before arriving, you have felt the same infrastructure at work. And this is not a bug, it is an architecture. This is not a bug, it is an architecture. One built over decades, layered with intermediaries, governed by regulations, and held together by institutions most people have never heard of. Today we are going to open that architecture up and look inside. We will explain what clearing and settlement actually mean, who the key players are, why the system was built this way, and why, despite enormous technological advances, certain delays have proven surprisingly difficult to eliminate. The invisible machinery that moves money around the world. This is a topic that sits at the foundation of modern finance. Understanding it changes how you think about markets, risk, and the invisible machinery that moves money around the world. The difference between a trade and a settlement. When two parties agree to buy and sell a financial asset, that agreement is called a trade. The trade happens in an instant. A buyer and a seller match at a price. The exchange records it. Done. A trade is merely a promise, but a trade is merely a promise. It is a contractual commitment to exchange an asset for money. The actual transfer of the asset and the actual transfer of the money, those happen later. And the process of making that transfer happen reliably, accurately, and safely is what we mean by clearing and settlement. These two words are often used together, but they describe distinct steps in the process. Clearing, everything between trade and settlement. Clearing is everything that happens between the moment a trade is executed and the moment it is ready to settle. It includes verifying that both parties agree on the terms of the trade, calculating what each party owes the other, and managing the risk that one party might fail to deliver before the final exchange occurs. Settlement, the actual transfer of assets and cash. Settlement is the actual transfer. The buyer's cash moves to the seller. The seller's securities move to the buyer. Ownership changes hands. The obligation is discharged. The trade is complete. Between these two steps, significant infrastructure is required. Risk must be managed. Positions must be netted. Records must be reconciled. And all of this must happen across thousands or millions of trades simultaneously, involving counterparties who may be located in different countries, operating in different time zones, using different systems. A coordination problem at enormous scale. This is why clearing and settlement are not simple. They are a coordination problem at enormous scale, with real financial consequences if anything goes wrong. The players, who actually moves the money. To understand how this system works, you need to know who the key participants are. There are several layers, and each one serves a specific function. Layer 1, the exchange or trading venue. The first layer is the exchange or trading venue. When you buy a stock on a major exchange, that exchange is matching your order with a seller. It records the trade and sends the details downstream for processing. The exchange itself does not hold assets or move money. It is the place where buyers and sellers find each other. Layer 2, the clearinghouse, central counterparty (CCP). The second layer is the clearinghouse, also called a central counterparty or CCP. This is one of the most important and least understood institutions in modern finance. When a trade is submitted to a clearinghouse, the clearinghouse steps in between the buyer and the seller. It becomes the buyer to every seller and the seller to every buyer. This is called novation. What this means in practice is that neither the buyer nor the seller needs to worry about whether the other party will make good on their obligation. The clearinghouse guarantees it. If the seller defaults before settlement, the clearinghouse steps in to complete the delivery. If the buyer defaults, the clearinghouse ensures the seller still gets paid. Clearinghouses require margin, collateral posted by members. This guarantee does not come from nowhere. Clearinghouses require their members to post margin, collateral that can be drawn upon if a member fails. They maintain default funds, contributed to by all members as an additional buffer, and they conduct daily mark-to-market calculations on open positions, collecting or returning margin as market prices move. Layer 3, the Central Securities Depository, CSD. The third layer is the Central Securities Depository, or CSD. This is the institution that actually holds the securities in digital book entry form. When settlement occurs, the CSD updates its records to reflect the new ownership. In the United States, this function is performed by the Depository Trust Company, or DTC. In the U.S., the Depository Trust Company, DTC. Layer 4, Custodian Banks. The fourth layer is the custodian banks. Large institutional investors hold their assets through custodian banks who interface with the CSD on their behalf, manage the settlement of trades, and handle related corporate actions like dividends and stock splits. Layer 5, Brokerages. And finally, at the retail level, there are the brokerages. When you buy a stock through a brokerage, the brokerage is interfacing with all of these layers on your behalf. You see a simplified view. Beneath it is an entire chain of intermediaries. How netting works and why it matters. One of the most powerful functions performed by clearinghouses is netting. It illustrates why centralized clearing is so much more efficient than bilateral settlement. Netting, the process of offsetting obligations. Imagine a simple scenario. Broker A owes Broker B $1 million worth of stock. Broker B owes Broker C $1 million worth of the same stock. Broker C owes Broker A $1 million worth of that same stock. 3 obligations, without netting, 3 separate transfers. If each of these obligations settled independently, 3 separate transfers of stock and 3 separate transfers of cash would need to occur. 3 times the operational complexity, 3 times the collateral requirement, 3 times the settlement risk. With netting, net settlement is 0. With netting, the clearinghouse observes that these 3 obligations cancel each other out entirely. Net settlement is 0. No stock needs to move. No cash needs to move. All 3 obligations are extinguished without a single transfer. In the real world, across millions of trades per day, netting reduces the gross settlement obligations in a market by an enormous percentage. In some markets, clearing and netting reduce the actual value of transfers that need to settle by 90% or more. Netting can reduce settlement volume by 90% or more. This matters for several reasons. It reduces the amount of collateral that participants need to post. It reduces operational risk. It reduces the systemic fragility of the market. And it concentrates risk management in a single, well-capitalized, highly regulated institution rather than dispersing it across thousands of bilateral relationships. The T+2 system and how we got here. For most of the history of modern equity markets, settlement took considerably longer than it does today. In the early days of stock exchanges, trades were settled on a weekly basis. Brokers would meet physically, exchange paper certificates, and transfer cash. Early markets, weekly settlement in paper certificates. As trading volumes grew, the industry moved to standardized settlement windows. In the United States, the standard for equity securities was T+5 for many years. In 1995, the industry moved to T+3. In 2017, it moved again to T+2. In May 2024, the SEC mandated T+1 settlement for most U.S. equity securities. T+5 before 1995. T+3 1995 to 2017. T+2 2017 to 2024. T+1 May 2024 to present. Each of these transitions was significant, required substantial coordination across the entire industry, and came with genuine operational challenges. Systems had to be rebuilt. Processes had to be redesigned. International coordination was required. The push from T+2 to T+1 was accelerated in part by the events of January 2021, when extreme volatility in certain retail-favored stocks exposed a specific vulnerability in the settlement system. During periods of high volatility, clearinghouses increased their margin requirements substantially. Several brokerages found themselves facing margin calls they struggled to meet, leading some to restrict trading in affected securities. January 2021, settlement system under stress. One response was the argument that faster settlement would reduce margin requirements during volatile periods because the window of risk exposure would be shorter. This argument ultimately contributed to the regulatory push for T+1 settlement. Why delays still exist? Given that we live in an era of instant digital communication, real-time data processing, and same-day money transfers in many contexts, the obvious question is, why does settlement still take any time at all? Why not T+0? The answer lives at the intersection of technology, regulation, operational process, and international coordination. Reason 1, the affirmation and confirmation process. The first reason is the affirmation and confirmation process. Before a trade can settle, Both sides must confirm that they agree on the exact terms: the security, the quantity, the price, the counterparty, the settlement instructions. In the institutional market, where trades are often allocated across multiple accounts after execution, this process involves multiple parties and can take hours. Errors must be caught and corrected before settlement, not after. Reason 2. Cross-border complexity. The second reason is cross-border complexity. A trade between a U.S. institutional investor and a European counterparty involves two different central securities depositories, two different currencies, two different regulatory regimes, and potentially two different custodian chains. Different markets have different settlement windows, and aligning them requires either waiting for the slowest link or building sophisticated real-time reconciliation systems that do not yet exist uniformly across all markets. Reason 3. The role of cash in central bank payment systems. The third reason is the role of cash. Securities settlement requires not just the movement of securities, but the simultaneous movement of cash. In most systems, final cash settlement runs through the central bank. Central bank payment systems operate on specific schedules. They open and close at specific times. They process transactions in batches at specific intervals. Moving to instantaneous settlement requires either real-time central bank payment systems or alternative cash settlement arrangements, neither of which is universally available. Reason 4. Operational resilience. The fourth reason is operational resilience. Faster settlement reduces the window to catch and correct errors. Currently, there is a period during which discrepancies can be identified, reconciled, and fixed before the actual transfer of assets occurs. Compressing that window creates operational risk. A system where errors cannot be caught before settlement is a system where errors must be unwound after settlement, which is far more expensive, legally complex, and potentially destabilizing. Reason 5. Institutional coordination. The fifth reason is the challenge of institutional coordination. The settlement system involves thousands of participants: brokerages, clearinghouses, custodians, central banks, depositories, fund administrators, all of whom have built their operations around the existing settlement cycle. Moving all of them simultaneously to a faster cycle is an industry-wide coordination problem of significant complexity. Blockchain, tokenization, and the promise of real-time settlement. No discussion of settlement delays is complete without addressing the technology proposed most frequently as a solution: distributed ledger technology, commonly associated with blockchain. Distributed ledger technology, the theoretical solution. The theoretical case for blockchain-based settlement is straightforward. A distributed ledger shared among all participants could allow for simultaneous atomic settlement. Atomic meaning that the transfer of the security and the transfer of the cash happen in the same instant as a single indivisible transaction. Either both happen or neither happens. There is no window of exposure. There is no counterparty risk in the traditional sense. Atomic settlement. Both legs transfer simultaneously or neither does. This concept is called delivery versus payment, and ensuring that it happens simultaneously is one of the core functions of the clearing and settlement system. A distributed ledger could make it automatic and instantaneous. DTCC exploring distributed ledger applications for settlement, central banks developing CBDCs for real-time cash settlement, tokenization of real-world assets, an active area of development. Several initiatives are underway. The Depository Trust and Clearing Corporation has been actively exploring distributed ledger applications. Various central banks have been developing central bank digital currencies that could serve as the cash leg of real-time settlement. The tokenization of real-world assets, representing securities as digital tokens on a distributed ledger, is an active area of development across both the public and private sectors. But none of these initiatives has yet displaced the existing settlement infrastructure at scale. The challenges are not primarily technological. They are regulatory, legal, operational, and political. Central banks and financial regulators are appropriately cautious about changes to infrastructure whose failure would have systemic consequences. The challenges are regulatory, legal, operational, and political, not technological. The movement toward faster settlement is real, but it is a gradual, coordinated, carefully managed transition. Systemic risk and the concentration question. We mentioned earlier that the concentration of risk management in central counterparties is both a strength and a source of criticism. Concentration of risk, strength, and vulnerability. The clearinghouse model works by centralizing counterparty risk. Instead of every participant worrying about every other participant's creditworthiness, all participants worry only about the clearinghouse, which is well-capitalized, highly regulated, and designed specifically to manage this risk. The 2008 financial crisis demonstrated what happens when counterparty risk is decentralized and opaque. The bilateral over-the-counter derivatives market, where trades were made directly between institutions without central clearing, became a source of systemic panic when participants could not assess their exposure to failing counterparties. 2008. Bilateral OTC derivatives market created systemic opacity. One of the major regulatory responses to 2008 was the mandatory central clearing of standardized derivatives. But concentration also creates its own risks. A clearinghouse is now, by design, a systemically important institution. Its failure would be catastrophic. A clearinghouse failure has never occurred in a modern large-scale market. The honest answer is that a clearinghouse has never failed in a modern, large-scale financial market. The resilience of the system in a true stress scenario remains, in some sense, untested at the limit. This is a reason to take seriously the ongoing work of clearinghouse regulation, stress testing, and recovery and resolution planning. What faster settlement means for investors. For most retail investors, the transition from T+2 to T+1 has been largely invisible. You may notice that shares appear in your account faster after you buy them, or that cash from a sale is available slightly sooner. The more meaningful implications are at the institutional level. The faster settlement reduces margin requirements and capital tied up in the system. Faster settlement reduces margin requirements at clearinghouses during normal and stressed market conditions. It reduces the capital that brokerages must hold against unsettled trades. Over time, if global markets converge toward T+0, portfolio managers who sell a position could redeploy the proceeds the same day. Cross-border investors would face less currency and market risk between trade execution and settlement. And the need for large pre-funding of settlements that currently ties up significant capital would be reduced. Real reduction in friction across the global financial system. These are not merely theoretical benefits. They represent a real reduction in friction in the global financial system, friction that currently has costs borne by participants at every level. The system is invisible to most people most of the time. The clearing and settlement system is invisible to most people most of the time. It works reliably at enormous scale across trillions of dollars of transactions every day. And precisely because it works, it rarely draws attention. But it is worth understanding. It shapes the risk structure of financial markets. It determines how capital is tied up and for how long. It sits at the center of every regulatory conversation about market stability. And it is currently in the middle of a gradual, consequential transition toward faster, more efficient, more transparent operation. The delays are not evidence of technological failure. The delays that still exist in this system are not evidence of technological failure. They are evidence of the difficulty of coordinating complex, global, high-stakes infrastructure across thousands of institutions, multiple regulatory regimes, and decades of accumulated operational practice. That coordination is slow. It is deliberate. And in a system where a single failure can cascade across the global financial system, deliberate is not a flaw. Deliberate is not a flaw. It is a feature. It is a feature. How clearing and settlement really work, and why delays still exist.